All right. So in this video, we want to go over all of the potential deal structuring tactics that you can use, right? So we're going to be talking about creative deal structuring. This can be in M&A deals. This can be in regards to, usually still the main baseline is the 80-10-10 rule, but there's all these different mechanics, all these different concepts to think about when putting together a deal. And so I just want to make sure that you have the right tools or arsenal in your belt to kind of pull from when you need to figure certain things out, right? So what we typically make sure of is that every deal should have at least 10% seller financing, right? It goes by a few different ways: seller carryback, seller note. But basically what this is that the seller agrees to finance a portion of the purchase price, and so you'll typically pay that over time. So the great thing about it is that it helps make sure that, okay, the seller has some skin in the game from a buyer standpoint. It makes sure that, they're not just going to take the money and run, right? They might still do that, unfortunately, but it'll hopefully reduce. It's more of an indicator that if a seller is not willing to finance any portion of the deal, typically for me that's kind of a yellow or red flag, because it's giving me vibes that maybe they don't feel like the business will be able to generate the cash flow required for them to feel like they can buy it, get the rest of the funds. So that's not always the case, right? Sometimes the seller just has so much control because maybe they just have a fantastic business and they have a lot of competition. But just something to keep in mind of is that most deals do get done with some sort of seller financing. 20% might be pushing it, but at least 10% is very normal, very average, and something that you should push for. And so typically the interest rates actually end up being a little bit lower than what you see with the SBA 7A. So the interest rates, generally speaking, I mean, 5 today is a little bit on the lower end, but typically we recommend buyers start at maybe about 6%, and then usually lands on 8% after some negotiation or something. But the good thing is that the seller note will end up being help to make sure that you can get the equity capital. I mean, sorry, the deal structure in the way to fit the 80-10-10 rule. But the key thing to just realize, though, is that it's really the SBA 7A repayment period of 10 years and that 10-year amortization is actually very good. And so unless you can get a seller to agree to a 10-year payback, which is very difficult, right? I do have it here, but most of them typically fall between 4 to 5 years. When you start pushing and kind of adjusting the way that you're going to calculate the deal structure, right? When the seller note amount increases above or starts to increase, and the amount of money you're going to take from the SBA 7A decreases, it'll actually reduce your DSCR in some cases, because even though you have a lower interest rate with the seller, your amortization period is lower. And so basically that same dollar amount payback is paid back over 5 years rather than 10 years. And so your principal and interest are being increased, or really your principal, not your interest, but your principal would be higher, and therefore the amortization is higher and the DSCR would go lower. So I just wanted to flag that the seller financing is great, right? Less upfront capital needed, easier loan approval, right? Lenders really like the seller financing because it shows a sign of confidence, like I mentioned before. And so it's definitely a good situation for you, but it can be something just used as a leverage point, right? So these are different potential levers and kind of ways you can get to the final purchase price by, hey, seller, I understand you want this amount of money. I don't have this today, and the SBA is only going to cover 80%. In order for me to cover the gap, then I'll be, just needing you to be able to kind of put in that amount of capital, for example. So seller financing, win-win strategy. That's a great one to keep in mind. Now, one more here that I just want to keep in mind. Unfortunately, we don't have the ability to do this with SBA 7A loans. So this sometimes falls for larger deals, but I definitely still want to call it out and flag it that an earnout agreement is something that's very common. You'll hear about it a lot in private equity deals and in kind of public company deals. But basically, it's a contractual agreement that allows the seller to receive additional compensation after the sale, right, based on the business performance. So typically, when public companies buy another company, you might hear that, hey, they keep the seller around, right? The seller has to vest into it, and so what'll happen is that a buyer typically pays a portion of the purchase price up front, and then the remaining portion is contingent on the business's performance, right? So this is how public companies and private equity companies get their people to get the sellers to kind of stay on and all that, because basically the seller still needs to continue working on in the business in order to hit their earnout amounts. So the SBA 7A unfortunately doesn't like this because they're trying to create a tool that allows for the transition of business owners when they're retiring, when they're selling their business. And so you won't be able to use it for SBA 7A or 80-10-10 type deals. But I still wanted to make sure that you have it as an arsenal because it can be something if you're doing a deal outside of the ordinary, outside of using the SBA 7A, earnouts do end up occurring. And also just wanted to flag it in case a seller tries to negotiate an earnout with you as the buyer. You just need to be mindful that if you're going the SBA 7A route, that you won't be able to actually go for that. So, it can be smart for both parties. I definitely understand why it gets done, right? It aligns the financial incentives and rewards with future business performance. So you as the buyer can afford to pay more for the business basically because the business is generating more revenue. But just something to keep in mind. It's a tool again, but if you're using the SBA 7A, you won't be able to do that. So the other one that is obviously important to understand is that when you have to bring in preferred equity or when you need to bring in investors, they have a certain typical market practice standard. And again, this is all negotiable, but this is I just want to tell you what's average and what's the industry trend. And so then you can kind of adjust from there. Again, none of these are hard and fast rules, but again, giving you an overview of what, if you know that an investor has done a lot of these types of M&A deals and has done preferred equity deals, then this is what they'll be expecting in some fashion. And so typically what those look like is that they'll provide some of the capital, provide some of the equity. They'll want to step up in basis. And so what I mean by that is that let's say it's $1 million deal, right? And you get investors to put in 100K. Math tells us that's just 10%, right? But an investor would want a 1.5x step up or something. That's pretty average. Sometimes if they know you're desperate and they get aggressive or it's a risky deal, sometimes they might require a 2x step up. Or if it's a friend, they might be okay with 1.25x step up. And so basically what that means is that if it's 1.5x step up, rather than, they only put in 10% of the deal, but they're going to get 15% of the equity, right? So you can see that is how they obviously have a large incentive, because not only are they getting that equity, but they're also securing a fixed return, which is why we call it the preferred equity, because they're basically going to be getting some preferred payout and guaranteed payment essentially of that percentage. So let's say they put in $1 million and you agreed upon a 10% annual dividend or annual return for them. They'll get their normal percentage of equity, right? But then they'll also basically get that guaranteed preferred return. So just something to keep in mind of is that these are all different tactics and tools that are a little bit out of the ordinary, right? They're still kind of relevant and they'll be something you use. But if you need to get a deal done, these are all different potential elements that you can introduce or look into to be able to close the gap from any purchase price.